Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. Well, the market sold off, as we talked about last week, but I'm still expecting it to make a new high, although it pulled back pretty good this week, a little bit further than I was anticipating. But we should see a new high, and if you look at the way this pattern is playing out, it should come in and around here, around the 2145, 2150 area, somewhere around there. So the one reason I think it's going to make a new high still is there's not a lot of elevated movement in the VIX. Let's go look at that right now, and you'll see why I'm saying that we're likely to make a new high. The VIX kind of tells you what the underlying fear in the market is, and you can see here that the VIX is, even though the market was down pretty good this week, the VIX barely really lifted from where it was. So it's still it's not even in the middle of this last move down. So even though the market's in the middle roughly of that last move up, the VIX hasn't even made it to the middle of this move down here on the VIX. So I'm expecting to see the VIX to drop a little bit. I don't know if it'll make a new low, but we should see it drop as the market's coming up and making new highs this coming week. Let's see. Let's look at all the markets have closed their gaps, so there's nothing really to see there. Let's look at the interest rate market. It's the 10-year Treasury. It continues to follow this trend line that we drew here a few weeks back, and it did have a pullback here. And I would say, it could pull back a little bit more, but it might be that we see the 10-year Treasury yield lift a little bit next week, as it tends to just walk this trend line up. Now, at some point, it'll start pulling away from this trend line pretty rapidly, but obviously we're not there just yet. The Euro US dollar, it continues to chop around here at this area around the 108, 109 area, and it's kind of following this trend line downward, and it's really at a point where it looks like it could kind of break this and come up into this resistance area that we had drawn here a while back. Next week is going to tell us a lot. So if we get a candle that looks like this, where we close above this week, then I think you'll see the euro move on up to this resistance area here above this prior peak high back here in February. So you'll see the euro move north of this 115, 116 area before it pivots and starts to come back down. And I don't know, the euro could be done going down. This could just be the up, down, up in a new uptrend, and which could make sense given that some of the turmoil is over with, at least for now, over in Europe. So I don't know how that happened, but now it won't go there. There it goes. Let's look at the Germany market. It continues to walk that trend line. It's interesting how these trend lines kind of hold up. I don't know how long ago we drew this trend line, but it was quite a while ago, and it's breached it a couple times. But more or less, it's following it pretty carefully there. If you look at the UK, it's still unclear to me whether we're following these markets or they're following us. But the UK now looks weaker with this past week's price action, and it looks like it wants to come on down. It might pause a little bit and then come down, but it's tested the underside of this trend line, which is pretty typical in technical analysis, and then it's resuming its trip down into this direction here.
So it looks like to me the UK could be leading us lower. So we looked at volatility. We look at the yield on the 10-year Treasury. Let's go down. One of the things I've been talking about lately is that the market is getting thin, and what I mean by that, there's a term called advanced declines, or new highs and new lows. So there's people that track how many new highs there are in the market versus how many new lows, 52-week highs, 52-week lows, and this number continues to expand in the direction of lows. And really what you've got is kind of a handful of companies more or less holding the market up. So let's look at some of these leaders real quick, and then we'll go and look at some of the sectors. So one of the things you're seeing, like this is Accenture, you're seeing a lot in healthcare. Let me shorten this to like a 2-year chart, a daily. So you can see that's a pretty strong trend. So that's been a leader. Amgen, it's been a leader, although it's been trading sideways since the first of the year. Apple, it's been a leader, although it's been trading sideways since March. But these are leading stocks in the market. Biogen was a leader, and you can see here it had earnings the other day, and the market just killed it. I mean, it took it. What is that? That's over 100 points down in one day. How would you like to be holding that stock and have a 100? You know, you get 1,000 shares and it drops by 100 points in one day. And you can see here, interesting enough, too, this is the way this gap worked. It gapped all the way to here, to this point here, and then it moved down from there. So it gapped to about 330, 335, and then proceeded to sell off another $35. That's pretty discouraging when you get gaps like that. Cerner, you can see Cerner was leading, had a pretty good trend here. Broke the trend line, and you can see that it's kind of testing the underside of that trend line, which is pretty typical. So what I'm showing you here is that the markets they're starting to develop some cracks in it, and you can see here this will probably come back up. You know, maybe make a new high. Although this looks like some pretty serious selling action, and you do have earnings coming up, so Cerner doesn't look all that great. Facebook still leading pretty strong. Facebook's almost at $100. That's amazing. It's basically a time-wasting tool. But anyway, that's my opinion. Goldman Sachs is still pretty strong, although it's showing some cracks here. We had a pretty strong move down in Goldman Sachs right here, and then kind of chopped its way higher, and then this is looking like it's picking up steam. And so you know what I've talked about before. If this is the first move down from an important high, so this would be an important high right here. And if this is the first move down and this is the first correction, then Goldman Sachs could be looking to move into the 190, sub 190, 185 area in its next move. So that's going to be it's going to be pretty good. It's probably going to be something going wrong in the market if Goldman Sachs does that. Google was showing some strength, had really good earnings information here, but then you can see that the market sold that off rather quickly, and this is usually not a very good sign. Normally what will happen is you get a gap up like this in earnings, and the market, it'll just trade kind of sideways to slightly down for sometimes weeks, and then it'll lift again. And you can see here that these are daily bars, by the way, and you can see here that it hit a high, it sold off from that high, and let me zoom back in. It sold off from that high, and this is a candlestick pattern called a shooting star. So you generally, what you would do is you would take a short position below the close of the shooting star and trade that to the downside. Now it's just like a hammer at the bottom of a trend. So a hammer appears at the bottom of a trend, but if you flip it over, In fact, let me just show you. If you flip it over, see that's a hammer. See the hammer right here? So it's a hammer when it's in the downtrend, and when it's in the uptrend, it's called a shooting star. This is usually a very bearish sign. So Google showing some weakness. JP Morgan has been strong, but it looks like, it could, if it breaks this trend line, it looks like it could fall back into this low 50s area. LinkedIn's kind of broken and messy, but it was a leader. Regeneron is another, it's a biopharm type company, and it's been leading. This has been one that people have been making a lot of money in trading. A lot of institutional people. United Healthcare, you can see it's pretty strong. But these are basically the areas. You got healthcare, biopharm, some tech, although some of the tech is weakening. Some semiconductor, although some of the semiconductor is weakening. Let's look at the sectors real quick, and I'll show you. So here's the. Let me go to sector spiders. There's too many in that category. So here's the SOX. Here's the Philadelphia Semiconductor Index, and you can see here, the SOX is weakened quite a bit. That's a pretty serious downtrend. It's broke the 30-day, the 50-day, and the 200-day moving average, and those are all pretty important moving averages that are looked at in the market. So what would you if you're in a semiconductor stock, or you're wanting to, let's say, trade short a semiconductor stock, what you're looking for here is you're looking for the semiconductor index to come back up to this 200-day moving average, and then you would take a short position there and go for the next leg lower. That's kind of what the market starts doing when it starts selling off. It'll start kissing the underside of these moving averages and then rolling over. Now here it didn't. Back here in October, it just slammed right through it and kept going. But you can see here, this is more of a gentle topping process and then a break, whereas this one was just kind of moving up and up and up and down, up and down, up and down, and went down and then right back up. So this is more of a topping look here as you kind of arch across the top of these highs. And it could come up a little higher, maybe just above the 200-day. You can see there's a let me point out, there's an area right here, a pivot right here that it could revisit and then roll over. Of course, there's a pivot right here as well. So somewhere either here and then down, or up here and then down, is probably what's going to happen there in the semiconductor index. But in general, I just want you to look at these in general. So this is XLY, which is the consumer discretionary, which is still showing fairly strong, although some of the stocks in there are not as strong. You can look at like Bed Bath & Beyond. It's kind of down. There's others. Target, it's starting to fall down. Walmart. If I can type, it's starting to slip. So sometimes you have to go look at the stocks in the sector to tell a little bit more about what's going on there. Here's consumer staples, which is more like groceries and things like that. General Mills would be in there, and companies like that. Healthcare, we talked about how healthcare has been strong. Although you can see there's a pretty good gap down here, and if you zoom in, this is a substantial move for something like XLV. These don't move that much because they're kind of an aggregation of a bunch of stocks. And then of course XLE, the energy sector, it's it's been whacked pretty good. But here's a good example. Here's a great example, actually, of how the market moved up. This is the 200-day moving average, and then it just rolled back over. And you can see this is a great trade if you're on top of this. Here it didn't quite make it up to the 200-day moving average. Kind of tested this confluence of the 30 and the 50 and then rolled down. But this is what happens. The same thing happens on an uptrend. Again, if you flip this, well, I can't flip it right there. But if you flip this, it's just the other, you can see here where it kissed the 200-day moving average right here and then bounced. So it's the same kind of thing. It's just, you can see here it touched the 200-day moving average and came down. Or in the uptrend, it came to the 200-day moving average and bounced up. So the 200-day moving average is a very important moving average. A lot of institutional investors look at that. And so if the institutional investors are looking at it, then we should be looking at it as well. This is the financial sector. We talked about that's pretty strong still. Utilities. One of the reasons utilities is starting to show a little weakness is because of that 10-year Treasury. There are people looking at that 10-year Treasury. Utilities usually, they're very capital-intensive industries, and they generally do poorly in a rising interest rate environment. They do better in a falling interest rate environment. So that's why you're starting to see utilities crack here a little bit. And some of these relationships, if you know them, it helps you understand, what's happening on the chart there. The XLB is the materials sector. And of course, materials is, some people say anything you drop on your foot and it hurts. And of course, we know gold is down, copper's down. If you look at Freeport-McMoRan, which is a very important company, owns a lot of copper assets, you can see that they're down, dramatically. Look at this. That is one, it looks like the oil chart, basically. So, this is a very important company, and its stock is only $12. So there's a lot of selling going on in that sector. XLK is technology, so we talked about technology. And technology is kind of a mixed bag. There's some like Twitter. If you look at Twitter, Twitter's, looks horrible. It just kind of chopping around. And if you look at Facebook, which is technology, it looks great. So it's kind of a mixed bag in technology, and as things start to change there, you'll probably see more and more weakness. XES is the oil and gas equipment sector, and of course you can see that's down. If you look at the oil and gas production companies, XOP, it looks very similar. You almost can't tell those charts apart. XES and XOP, they look identical. So I just want to point out that this is how the market shifts from uptrend to downtrend, as you have sector by sector starts to weaken, and the stocks in those sectors begin to weaken, and then eventually there's nowhere to roll money to, and there's no strength anywhere, and so people start selling. They start selling stock. They start selling those losers even more aggressively, and then they even start selling the ones they have gains in just to take money off the table. DBC is another. DBC is a commodity ETF, and you can see here. It's at basically all-time lows. Commodities, if we go back 10 years, commodities peaked here in 2008 on this index at 45, and today we're at 16. So we got a pretty dramatic, sell-off happening in commodities. Of course, if you look at gold, GLD, you can see that here. And of course, if we go over to our gold chart /GC, you can see it's even more dramatic here. And we can look at a weekly. This is the long-term trend of gold. So you have this huge run-up, and now we're having a pullback. The good thing about a pullback is it gives you an opportunity to get in, at better prices. So gold, if this was the first move of, so I've been talking about the 10-year Treasury for a while, and I've been talking about the first move up and the first pullback. So if this is the first move up on gold up to 1923.70, and this is the first pullback, then what does that tell you about the next move up in gold? It's going to be ginormous. So, gold is probably at decent prices here, but I would gather from looking at some of these other commodity charts that gold is actually going to go much, much lower. We can glean a little bit of that from the dollar. I'll share something here with you. You have this, this big run up in the dollar into 2001, and then we've had this pullback, and then the dollar has rallied really hard here recently. It's pulled back and it's starting to rally again. So there's not a whole lot left in this dollar move here. You're going to see it move to about this 103 area and then pull back here back to the 91 area. So we got a little bit more to go in the dollar, maybe even a little bit more than that, maybe up to 110 area. And then we're going to pull back into this pivot here and then make a new move higher. But that new move higher, one of the things I've always done is I've used, there's a tool in here called Fibonacci. It's in most trading platforms. And if you go to Fibonacci retracements and you pick an important low like this is a very important low right here, and you go to the high of that move. So this move right in here is what I'm looking at. And you click on that and you pull this back to the low. And you look at where where there's two important numbers here that I want to point to. One is the 261.8%, which is 121.41 on the dollar, and the other one is the 4.236 or 423.6 retracement area, which is 152 on the dollar. So this Fibonacci tool, usually when you have an important low and you pull back like that, the run usually goes somewhere in between this 261 and 423. So you're looking at a move ultimately of the dollar to at least 121, 122, and maybe as high as 152. So this is going to, if the dollar gets this high, 152, you're going to see gold even go lower, which is hard to imagine, but one of the things I learned is that the market can do anything. And if you understand that the market can do anything, a lot of people will say, well, that's impossible. The market can't do that. And it's just not true. The market continues to surprise people. And it's better just to have an understanding that it could do anything. So going back to the gold chart, and there's people writing about this. It's not hard to find information, but we're really close actually right now to a pretty darn good bounce. You might see a bounce into this 1500 area, and it's going to be pretty rapid. I think it won't be near as long as this. It might be half this long, or even a third this long, and you'll see gold jump up into this 1550. Just under this area right here. In fact, let's put a line there so you can see what I'm talking about. This area right here was formerly support for gold, which means now it's resistance. So as gold kind of meanders its way up here, it'll probably hold this 1570 area. In fact, 1550 is just a good place to go ahead and get out if you're going long gold. And then from there, I would look for gold to make even a new low somewhere down here off this pivot low from 2008. This low here around 675. So now here's the deal: if you're holding out for gold, which I'll be honest with you, I am. I'm trying to actually buy some physical gold, but I'm not interested in buying it here. I'm actually more interested in buying it down here. But here's the rub. I don't know, and you don't know, and nobody really knows if you can actually physically get your hands on any gold when it's trading down here. So that's the part of the unknown that you just, I don't know how to answer that. Yeah, it'd be great to buy gold down here, but what if physically there's none available? Which really doesn't make any sense, right? If the price was falling like that, you would think people would be selling it like crazy, trying to get rid of it. But you could have a situation where there's physically no gold to actually get your hands on. A lot of people want to know what's driving this, and there's a couple different theories. I heard a guy the other day say there was 98 times more
paper contracts for gold than there was gold in existence. Well, that would surely drive gold lower, and there's probably a little bit of that. The other thing is maybe there's some. This is portending some deflation in the future. And the truth is, it might be a little bit of both. But the reasons aren't as important as what's actually happening. So, I think that's about it. I just wanted to show you some of the leaders and how the market was kind of thinning out, and then these reactions to earnings were not good. I think I showed you Google. Google's the one, to me, that was one of the most disturbing. I mean, these are just huge numbers. ISRG, you saw a little of that with the ISRG, but then it kind of recovered. So you can see here what happened with ISRG. And the reason I know about these is because I traded the earnings plays, and ISRG I lost money on big time because it gapped this blue box here. What I did is I sold a call up here. I sold a call, what's called a naked call right here, and at the other end of the box I sold a put. And the idea is that the stock, there's a lot of volatility right before earnings, and the idea is the stock would move, let's say, from here maybe to here, and then kind of chop around or whatever. But the idea is it wouldn't gap up outside the box, and that value of that call would go to zero, and I would capture that premium once the volatility ran out of the stock. But you can see what happened is it gapped up outside the box, which means I had to buy back this call. I had to buy a 535 call at, somewhere around in here, the 555 price. So, in fact, I always get out the very next day. So I probably got out down here on the low end, but it still cost me, I don't know, $800 or something. So, but that's earnings. If you're going to trade earnings, you can see here the other end of the box is down here at 465. So I sold a 465 put, and I sold a 535 call. And the idea is that once earnings are out, the price stays in this box, and you capture the premium from the put and from the call side. There's a lot of premium right before earnings in options because it's unknown, right? There's a lot unknown, and so there's techniques for trading that, and I was using a technique called strangle. I was selling strangles. Anyway, that's one of the reasons I know about some of these that acted poorly on earnings, including Google and this one, and Amazon. Amazon was another one that was really strong. Whoops. And I actually chickened out on Amazon because I had lost money on ISRG, and I changed my mind on Amazon. So I had sold a strangle originally like 2 days before earnings. I sold a put down here, and I sold a call here. And you can see that on Amazon it gapped way. I mean, it was $100, $100 gap. And like I said, I chickened out right before the close and bought everything back and got out of the trade. But you can see that probably would have been a loss because I probably wouldn't have held it past that day. And who knows, Amazon, I mean, and that's the problem is nobody knows the future, but Amazon could have come back down here a couple days later, and I'd have been fine and could have made my max profit on that trade. But I chickened out, so that happens sometimes in the market. It's the fear and greed, that drives your behavior. But anyway, that's about it this week, everybody. I've got these NinjaTrader charts. I looked at them earlier. The DAX, it's kind of hard to tell where we are there. Although, I mean, what's interesting to me is that we didn't come all the way up into this decision point, but clearly we're rolling over. And I think at this point, it's more likely that the DAX is going to visit this decision point area down here. But the reality is it's right in the middle, and we could get a bar next week that looks a little something like this, and then the DAX could be back on its way to this decision point here, and then
actually turn. So when you start getting close to these areas, it's really hard to trade in this direction because the risk is this. The risk is all this down here. So I tend to avoid those types of setups. I like to wait for, in this case, the DAX to get up into this area, and then look to trade it down to the pivot lower, as opposed to trying to start here and trade up to this point. So anyway, that's just a reward risk kind of thing. We already looked at gold. We can look at crude oil. Crude oil, this is a daily chart of crude oil. You can see here we had a TS3. These are usually pretty good signals. And, if you trade it you could trade it to the first target or to this target right here. Make 6 times your money. I didn't. Crude oil is a big contract. It's kind of, there's some, I know some ways to trade it, and I have traded it, but it's a rather large contract, so a pretty small move can cost you some money. So I want to look at the ES real quick on a weekly basis, because you can see it's hard to tell whether the pattern's complete, but you can definitely see the pattern, the ending diagonal. And I've got a lot of stuff here on the screen, but thought I had another view of this, but let me just draw some quick lines so you can see what I'm looking at. You got a line that goes there, and another line that goes across these tops here. So you can see that ending diagonal. You can see the 1, 2, 3, 4, and it shows that it could be complete, but this never did really make a new high, and I would expect it to come out above this trend line before it rolls over and goes down. So, and like I said, the return move is a DP to this area right here. So now this is these are the futures, but you would look for the futures to return to this 1755 area in pretty rapid fashion. It's going to be kind of a crash-like, type of scenario. So anyway, that's what I'm looking at right now. If anybody has any questions or they want to comment on anything, you can always email me at middleclassinvestor@gmail.com. You can comment on the YouTube channel. Go to YouTube and search under Middle Class Investor, and you can comment there. Or you can respond to a tweet or something like that. But some way I'll find you and respond to whatever your comments are or questions that you might have. If there's any particular instrument you want to look at, we can do that. But I will leave you with this picture of the ending diagonal, and hopefully you guys will come in next week. This is the 25th of July, and so next week, next week, let me say something right now about next week. I am taking some time off. I'm going on vacation. We're going out to the hill country and to the rivers out there in the hill country, and so I won't be in next week. If something important happens, I'll figure out a way to record a video. But if nothing really important happens, I'll probably just skip next week, if that's all right with everybody, and pick it up the following week. All right, everybody, thanks again for coming in. It's Middle Class Investor, and we'll see you next time. Take care. Bye-bye, all.